Just imagine that something bad happens in the economy and your stock crashes 30% down, but your portfolio barely moves. While others panic, you are calm. That is because you invested smart. Today, I will show you three ETFs on the Nigerian stock market that can protect your money from industry crashes and volatilities. If you keep buying only bank stocks or possibly only oil stocks, right? One bad policy or one bad earnings report can wipe out your entire gains. Instead of guessing winning stocks, right? Smart investors use ETF, that is exchange traded funds, to spread their risk automatically on the Nigerian Exchange Group, that is the NGX. Let me show you the three best ETF that will balance your portfolio. Number one, we have Griffin 30 ETF. This exposes you to the broad market growth. This ETF tracks the top 30 biggest companies in the Nigerian exchange. So instead of buying the GTCO, the Dangote cement, the Bua cement, the Nestle, etc., one after the other, you can just buy all of them at once. If one sector falls, another rises. It is like owning the entire Nigerian economy in just one click. You may wonder why this is powerful. It is because it gives instant diversification. It poses lower risk than having single stocks. It propels long-term growth. So the second ETF we look at is Vetgoods ETF. This one is for defensive stability. This ETF focuses on food and everyday products. And guess what? Even in recession, people still eat, right? Even in recession, people still buy soap. Even in recession, people still drink. In recession, people still buy their necessities. So during economic turmoil, consumer goods company does not crash as hard as banks or oil stocks do. Companies in this ETF include, you have Nestle, you have Cadbury, you have Flour Mill, you have PZ Cousins, etc. So you may want to ask if owning this ETF is important. Yes, of course, it is very important for you to own this ETF because they give more stable earnings. They are less volatile. They also protect during downturns in the market. This can be said to be your stock shock absorber, right? Meaning when things are being extremely volatile, this stock tends to give you cushion. The third ETF we shall look at is New Gold ETF. This one is for serious crisis protection. This ETF is different from the ones we have mentioned earlier. It tracks the performance of gold, and gold usually rises when inflation rises, naira weakens, stock market crashes, and most importantly, when there is war. You can see what is going on in the world right now. You can see that as a result of the warfare between the United States, Israel, and Iran, a lot of stocks are slowly sliding down. So gold, on the other hand, is a big hedge against situations like this. Gold will not experience a high volatility that is being experienced in the stock market as we speak, be it for oil stock, be it for defense stock or other stocks. So gold is relatively stable, right? I'm not saying that gold doesn't go down. It goes down, but at a very slow pace. Then after a while, it gets back up, and it doesn't go up at an extreme rate, right? Everything gold does is at a very minimal rate. So that is why gold is a big hedge against uncertainties, against unforeseen circumstances. So when stock falls, gold often goes up. This is balance. So you may want to ask that, Godwin, why do I really need this? right? Is this very important for me to hold this ETF that doesn't go up very much? Well, this is very important because gold is the ultimate hedge, right? It's the ultimate hedge against inflation. It also hedges against currency risk, right? You saw what happened in 2023, 2024. The inflation that we encountered in this country, that the MBS reported 34% inflation rate, while in the market we saw something that is not less than 100% inflation in the price of goods and services. So in this situation, gold seems to hedge against any currency risk. It is like your portfolio insurance at this juncture. Okay, let me use this analogy. Just think of gold as your financial seatbelt. While you drive, you always should buckle your seatbelt, isn't it? Right. So that is the protection that golds give you. Yeah, I'm just trying to grow my beard and see how to look on me. I want to have a different look, trying to keep it neat and tidy. So now let us look at how to combine these three ETFs, right? I will give you practical examples of three portfolio mixes that will totally fit your risk tolerance level. These will further tailor it to suit you. So I'm going to use an analogy that is likened to football. I know a lot of us watch and follow football, so it is very relatable. I'm talking about the defender, the midfielder, and the striker. So let's say you have about 1 million naira to start your ETF investment, right? These will be diversified across these three ETFs. That is the blue chip stocks, the consumer goods, and gold. So if you found this video informative so far, kindly do me a favor. Kindly subscribe to this channel right now. And also, you can like and share this video with people around you that wants to learn about investment and finance, right? So with that said, let's get back to the video. Number one, we start with the most popular of them all. That is the balanced portfolio. That is for the midfielders. This is you defending and striking at the same time on the pitch. Defending is you protecting your investments against losses. Striking is you playing to increase profits or earnings on your portfolio. Being a midfielder is what a lot of people choose. That is being in the middle of the mix. Your portfolio allocation goes like this. So you allocate 50% to Vetgoods 30, that is 500,000 naira. 30% to Vetgoods, that is 300,000 naira. Then 20% to new gold, that is 200,000 naira. This works because it gives you safety, right? And it also gives steady growth on your portfolio. It is very optimal on both spectrum of the dynamics. The second one we shall be looking at is the conservative portfolio. This one is for the defenders, right? If you know that your risk tolerance level is very low, that is, you hate big swings in the market, then you are a defender. That is the position you should always stick to. You prefer to protect your investment much more than you seek profit. Your portfolio allocation should look like this, right? You allocate 40% to Vetgoods, that is 400,000 naira, 30% to new gold, that is 300,000 naira, and also 30% to Vetgoods 30, that is 300,000 naira. This will work for you because you are heavily defensive with gold exposure. You are less affected by crashes. Your portfolio grows but slower. This style is ideal for retirees as well as cautious investors. The third one we look at is the growth portfolio, that is for the strikers, right? For the high risk tolerance investors. If you are a striker, you are just pursuing scoring goals, that is, you are just pursuing getting profit with little consideration for possible losses. This is for investors that seek higher earnings in their portfolio. I would just want you to know that higher returns comes with higher volatility and also comes with higher potential losses. If you are comfortable with market swings, then you should be fine in this category. So your allocation should look like this. You have 70% on Vetgoods 30, that is 700,000 naira. You have 20% in Vetgoods, that is 200,000 naira. You have 10% in new gold, that is 100,000 naira. This would work perfectly well because you have strong exposure to top NGX companies with higher upside potentials. You have little hedge with bigger dips possible. This is ideal for young investors. For best results, leave this investment for at least 5 to 10 years, right? You would see astronomical gain in your portfolio. Instead of gambling in one sector, here is what smart investors do that beginners do not. You should rebalance your portfolio like every 6 to 12 months. If your gold ETF goes too much, you can sell some and add to possibly your Griffin 30 ETF. If stock crashes, you should buy more just so that you cost average. This keeps risk low and returns steady. So if you want safer investment on the NGX, ETF is the smartest place to start. Don't chase hype stocks at all. Own the entire market, and with that, you would see your portfolio perform very well over the long haul. If this helped you, like this video and share it with people you know to help spread the good news of safe investments. Comment ETF in the comment section if you want me to do a step-by-step video on how to buy these ETFs. Do not forget to subscribe to the channel if you have not already. So check out this video to know how the witch operates that grows their portfolio. As I say, wealth is not luck. Wealth is built by information followed by execution.